We've all heard the saying, right, that property in Singapore always goes up. It feels like a sure thing until, well, it isn't. Today, we're digging into a pretty stark cautionary tale that really shatters that myth. A story about how one investor made a mistake that cost them almost $1 million. Yep, this is the number we're talking about. A loss of over $800,000 on one single apartment. And get this wasn't some random property in the middle of nowhere. This was supposed to be a prime piece of Singapore real estate. So that's the big question, isn't it? How on earth does this happen in one of the hottest property markets in the world? The answer, it turns out, reveals a really powerful lesson about timing, risk, and a potential trap that might be forming in the market as we speak. Okay, so to really get our heads around this, we need to look at a tale of two condos. First, we're going to break down the unit that took this massive hit. Then we'll shift gears and look at a new type of property that might just be leading today's investors down that exact same, very expensive path. So our story starts right here, at The Clift. It's a 99-year leasehold condo located smack in the middle of Singapore's central business district. We're talking about a 2-bedroom duplex unit. I mean, on paper, it's pretty much everything you'd want in an investment property, especially with all the expats looking to rent in the area. So what went so horribly wrong? Well, the answer wasn't the location, and it wasn't the building itself. It all came down to one thing: timing. This huge loss is basically a masterclass in what happens when you buy at the absolute tippy top of a market cycle. Let's just walk through this 13-year journey. The original owner bought this unit back in 2012 for a jaw-dropping $2.86 million, right at the peak of the luxury property craze. But just a year later, the government brought down the hammer with a bunch of cooling measures, like the additional buyer stamp duty, or ABSD. This was aimed squarely at the high-end market, and it basically froze that entire segment for over a decade. So when the owner finally sold in 2025, that massive paper loss became very, very real. Someone put it perfectly with this analogy. It's the real estate version of buying a hype stock at its all-time high. The seller paid a premium at the very top, full of excitement, and then just had to watch their capital go completely sideways for more than 10 years. Totally trapped. All right, so that's the backstory, but here's why it's so important for us today. Does that story from the past give us a warning for what's happening now? Are we seeing signs of a similar kind of peak forming in the current market? So the big question is, could history be repeating itself? Maybe not in the fancy downtown core this time, but somewhere else entirely. Well, the data is suggesting that the speculative fever has now moved from the city center to the suburbs. And this right here is where things get really wild. Just look at this comparison. Today, you could buy a resale unit in the downtown core, like the one at the Cliff, for around $1,900 per square foot, okay? But at the same time, brand new launch condos way out in a suburb like Tampines are going for $2,500 per square foot. Just let that sink in for a second. The suburbs are now more expensive than the city. This is a rare thing to see, and historically, it's a classic sign of a bubble. And that's not the only warning light flashing. We're seeing a few other classic signs of what's called a late cycle market. The point where growth has probably peaked and a downturn might be on the horizon. First, rental yields in the suburbs are really struggling to cover the mortgage payments at these crazy high prices. Second, as we just saw, suburban prices are starting to look a lot like city prices. And third, there's a huge wave of over 14,000 new condos about to be completed in the next couple years, which is going to create a ton of competition for anyone trying to sell. So let's actually run the numbers on this. Let's say you're buying in Tampines at these prices. You're obviously betting on a big payday down the road. So let's imagine the absolute best case scenario. You buy a unit for $2.5 million and you manage to sell it 5 years later for $3 million. That's a $500,000 gross profit. Sounds incredible, right? Well, this is where we need a serious investor reality check. Okay, so there it is. $500,000 in paper gains. This is the big, shiny number that gets everyone excited, the one that fuels all the hype. But honestly, this number is pretty much a mirage. It's before what we call the leakage. Let's take a hard look at where that money actually goes. First up, buyer's stamp duty. Boom, that's over $100,000 gone right off the top. Then you've got legal fees, a modest reno, and 5 years of mortgage interest, which alone is another $150,000. And we're not done. You've got property tax, maintenance fees, and of course the agent's commission when you sell. You add it all up, and your total expenses are almost $420,000. And just like that, your incredible $500,000 profit, it evaporates. It shrinks all the way down to this, a net profit of just over $80,000. That's what you're left with after 5 years of taking on risk, leverage, and all the headaches that can come with being a landlord. To put that into perspective, let's say your down payment was $625,000. Well, that 80 grand profit works out to an annual return of just 2.4%. You could have put your money into a simple, way less risky investment yielding 4%, and you would have done a lot better, with literally zero effort. That's the opportunity cost of chasing the hype. So what is the big lesson here? What do we take away from all this? It really boils down to understanding the difference between a value play and a growth trap. It's about shifting your mindset from being a speculator, just hoping things go up, to being an investor who's actually focused on the fundamentals. Think of it this way. The cliff today at its much lower price is a classic value play. It's a beaten down asset. A lot of the risk and downside is already priced in. On the other hand, that new launch in Tampines, you could call that a growth trap. Its high price is based on a perfect future scenario, that someone else will come along and pay even more for it. It's priced for perfection, and that means it's carrying a ton of expectations and a whole lot more risk. Look, if you remember just one thing from this whole explainer, let it be this. It doesn't matter if it's stocks or real estate, your entry price is probably the single most important factor that will determine your future returns. Buying a great asset at a bad price can easily be a worse investment than buying a mediocre asset at a great price. And that leaves us with a final question for you to really think about. When you look at the market today with all the noise and all the hype, you have to ask yourself, are you truly hunting for long-term value? Or are you just chasing the pump? Because the answer to that question could be the difference between a smart investment and an $816,000 mistake.